So this is a kind of tricky one to qualify and quantify, but I want to put it in here because it's often very, very useful, this. So social media now, the way that a lot of people use social media is this. When they are winning in a trade, they will wait until they think the trade is perfect before they announce how good they are at buying 50 pips away, 50 pips below, whatever it was. They will wait until they feel super comfortable until they start posting it. So we can leverage on this and we can say, okay, if we suddenly see a flurry of people saying, oh, I bought this, I'm long crude oil, I'm long euro, I'm long this, I'm long that, and it suddenly becomes a bit of a crescendo, we could think that actually that's probably the time it will reverse. Because if we think about the kind of what's actually happening, when people feel the most comfortable is when likelihood is it's in peak mode and it's going to pull back. And so that's one thing to be careful of, because very often, you know, we'll see that people announcing how good they are, how great they are, and they do it when they feel like there's no problem, and then ultimately that is the turning point. It's just I don't know why that is, just happens to be it. The other one is if you're trading a small cap stock, and we'll look at heavy retail involvement in a moment in a specific slide, but you know, this is when let's say a stock it's a small cap stock, it's got no institutional involvement really, it's you know, real kind of small nothing stock. It has news come out that's potentially, you know, groundbreaking. It's often in biotechs or stuff like that. So let's say they found a cure for cancer, or they haven't killed as many rats as they expected when they did the test, or whatever it may be. Brings in a load of people, gets announced to all the kind of gambling type traders out there, and social media will go something like this. You'll get people saying, I'm buying this, I'm buying this, I'm buying this. It will go up and up and up and up. How great I am, adding more, this is going to so-and-so. They'll reinforce their thesis, they'll shout about how great they are. That will bring in people who are kind of lurking and watching, and then it will start to dip down. And it will dip down, people say, I'm buying more, this is a great buying opportunity, it's going even higher, and then maybe it will start to go a little bit higher. And then when it dips even lower, you kind of see it go quiet, right? Because people don't want to announce, very few people on social media, specifically like Twitter, etc., will go, oh, you know, close that for a loss. They've just been bragging about how high it's going to go and how fully loaded they are, and they've got more, they've added more, and they've added more. You're going to get a few who say adding and adding, but ultimately it starts to go quiet. And that is them scrambling to get out of the position because they are wrong. They are now in a drawdown position, and anyone also who's followed them in is wrong. So anyone who rarely posts, won't be posting. Anyone who has been posting goes quiet because they're embarrassed that they've done that, and they're losing money, and they're concerned. So you get this kind of flow, if you like. Imagine a graph, a flow of kind of pulse of tweets going through. If you're talking about Twitter, which I am exclusively for this, you know, rolling. Then all of a sudden, as price dips down, the tweets stop, and you think, well, that's probably the top of that market for that move, because A, there's no institutional money anyway. It's all this retail money which is causing the push up, and now that buying's dried up. There's no one else left to buy. There's only one place for it to go down, and I all know that all those guys in there, we'll look at this in a second, are in it only for you know, pure gambling perspective. They just want it to go up quickly in the next 4 or 5 days. They're not interested in where it's going to be in 20 years time. They're not investing on this, so they're very sensitive to adverse price movements. So we can watch that social media flow, and as it kind of spikes and then starts to drift off again, and then it goes quiet almost as price is going lower, you know that the supply demand imbalance is what it's been doing. Massive demand, tilts a little bit back to demand, and then bang, we're on full supply because all those guys who bought are selling and no one else is interested in buying it because the story's gone and dusted. So next one, guys, short squeeze. Love the short squeeze when shorts are wrong. So normally, if we look at this, fundamentals normally dictate there's a great reason to be short. You know, people aren't normally short something unless there's a reason to. You know, hedge funds, money managers, investment firms won't be shorting something unless there's a real glaring thing. It's massively overvalued. It's this, it's that, the other. There's a thesis there, and it's normally a logical thesis, right? Because these guys are intelligent guys. And generally speaking, you can use stuff like finviz.com, especially for the equity side of it, or the commitment of traders, to see how the percentage of people who are short that. So let's stick with equities for now. A commitment of traders similar, but for commodities, but you can do that. But short float, for like finviz.com for your US equities, and there's also something like shorttracker.co.uk for your UK shares to see how many people are short. So people have to publicise the fact that they're short, and you can see how much of the float is short. So let's say 10% of the float is short, means that 10% of the whole amount of shares in issue are held in short. So they've got it's just an awareness that you've got, and often these guys will accumulate more and more shares. The short float will increase as the story starts to kind of get built up, and they say, well, it's ridiculously overvalued, it's not doing very, very well, they're dangerous, they're over leveraged, they need this, they need that, proper logical thesis behind it, and the short float starts to accumulate. As short starts to accumulate more shares, the short float starts to lift. And the percentage grows, and the percentage held short grows and grows and grows. And then you kind of get this scenario often, it's not always the case, but often you get kind of people being quite vocal about it. They're quite saying, oh, you know what, this is negative, this is bad, and they start putting press releases out, they start doing this, they start doing that. And what happens is you've got all these people who are very logically short this stock, and we use a stock example, but again, it could be the commodity. They're very logically short this stock. And then there's often a catalyst, and this is normally an unexpected response catalyst. So in other words, you often get bad earnings coming out. Let's say, stick with the stock example, bad earnings. There's a lot of people short on it, and you get bad earnings. And the stock then starts to rally. So these shorts are so impatient and so frustrated now. They've been in this thing for a long time. Perhaps it's ground upwards and just trended up, but they're still in it. They're still kind of hurting, but they're expecting it to go down to, 75% haircut. So they're happy to sit with it, adding more to the position. They're building a position. The short float's rising. Then maybe bad earnings come out and think, yeah, that's it, rub in their hands. And then we get a spike. We get a spike, and you get a dramatic rise in price from other buyers coming in. And then the shorts are desperate to cover because they're like, well, I'm down massively. I'm almost at my max pain point anyway. I've obviously got it wrong. And there's generally more of a concern because you could lose a massive amount of money being short. You can only lose your total kind of investment value, if you like. You bought 20 grand's worth of stock. You're going to go to zero. That's all you can do. If you short 20 grand's worth of stock, if the stock trebles, that's going to be worth 60 grand, right? So you've got to be... you've got to be careful with your shorting. So that's why people are mindful of it. So and also a lot of people will know that people have a big short float on a stock, so they will probably buy aggressively as well. So this is something else that can add extra fuel to the fire. If you think about the momentum ignition trade, and let's say you saw momentum ignition to new highs after a good rally, after an unexpected response, and there's a short float, man, you're ticking so many boxes here. You're like, this is grade A material, especially if it's matching your technical criteria as a good drive, a little tiny pull back on this, then you get your nice trigger. You've got the short squeeze, extra weight to the trade that you can either add to your grades, add to your filter, or have a separate thing, but it's something that's super, super powerful, super, super useful, guys.